At first, it looks like a win. Mortgage rates dip a little, listings tick up. Everyone starts whispering the same sentence again. Maybe this is the year. But here's the uncomfortable truth. In 2026, millions of people who should be able to buy a home still won't. Not because they're lazy, not because they didn't budget hard enough, and not even because home prices are too high in the simple way we talk about on social media. The real problem is quieter, more mechanical, and much harder to fix. Because the housing system didn't just get expensive, it got rewired, and most people never noticed. Think about what buying a house is supposed to be. You work, you save, you build credit, you borrow money, you pay it back over time. Simple story. That's how it worked for decades. But somewhere along the way, that story stopped matching reality. In the 1980s and 90s, the average home cost about 3 times the average income. By the early 2000s, it was closer to 4 times. Painful, but manageable. By the mid-2020s, in many cities, it's 6, 7, sometimes 10 times income. That's not inflation, that's a structural shift. And here's why this matters right now. 2026 is being sold as a normalization year. Rates stabilize, the economy cools but doesn't collapse, wages inch up. On paper, it looks like conditions are improving, but the system that decides who gets a house no longer cares about paper improvements. It cares about risk. And risk has been redefined. Let's rewind. After 2008, the entire mortgage industry was traumatized. Banks didn't just lose money, they lost legitimacy. So the response wasn't subtle. Lending standards tightened, regulations multiplied, risk models became paranoid. At the same time, something else happened. Housing stopped being just shelter, it became an asset class. Big money noticed that homes don't trade instantly. They don't panic sell overnight. They're slow, sticky, predictable, perfect for institutions. So while individual buyers were dealing with stricter credit rules, higher down payments, and slower wage growth, capital was flooding in from somewhere else. Private equity, real estate funds, pension money, corporate landlords, not buying one house, buying thousands. This didn't drive prices up overnight. That part came later. What it did first was change the floor of the market. Because when a professional buyer enters, they don't ask the same questions you do. They ask, can I afford this monthly payment? They ask, what's the yield? If the rent covers the debt and produces a return, the price almost doesn't matter. That's the first uncomfortable shift. Homes stopped being priced primarily by wages. They started being priced by cash flows. Now layer on interest rates. When interest rates exploded in 2022 and 2023, everyone assumed prices would crash. They didn't. They stalled. They wobbled, but they mostly held. Why? Because higher rates didn't hit all buyers equally. For a household, a higher rate can kill affordability instantly. For an institution with long-term capital, it's just a variable. They can wait. They can refinance later. You can't. So supply didn't rush back to the market. Sellers stayed put, builders slowed down, and inventory stayed tight. This is where 2026 gets deceptive. Even if rates come down a bit, the damage is already baked in. Because affordability isn't just about the rate today, it's about the price you locked in yesterday. Someone who bought in 2021 at a low rate has no incentive to sell. Moving would mean trading a cheap mortgage for an expensive one. So homes don't circulate, and when supply doesn't circulate, prices don't reset. Now comes the quiet killer: debt-to-income ratios. On paper, you might think you qualify. Good credit, stable job, decent income. But underwriting doesn't care about your future. It cares about your present ratios. Student loans, car payments, credit cards.
even subscriptions. All of it counts. Meanwhile, wages haven't kept up with asset inflation, not even close. So what happens? You don't get rejected because the house is expensive. You get rejected because the system says you're risky, even though the risk isn't reckless spending, it's structural. Healthcare costs, education costs, transportation costs. You didn't create those, but they live on your balance sheet. Here's the irony. The system claims to protect stability, but it quietly locks out the very people who would stabilize neighborhoods long-term, owner-occupiers. Instead, it favors buyers with liquidity, leverage, and patience. Now let's talk about the myth everyone clings to. The crash will fix this. Crashes don't fix structural mismatches, they reshuffle ownership. In a downturn, individuals lose first, capital steps in second. That's exactly what happened last time. Foreclosures didn't create a generation of affordable homeowners, they created a generation of renters. 2026 isn't about prices being too high, it's about the bar being set higher than incomes can realistically reach. Even modest homes now require high down payments, clean debt profiles, stable long-term employment, and the ability to absorb shocks. That describes fewer people than we like to admit. And here's where the story gets uncomfortable. Policy talks about helping buyers, but the system is optimized for lenders and investors. Rate cuts help asset holders first. Tax incentives inflate demand. Subsidies raise prices before they raise access. Every lever pulled to help tends to flow upward. Meanwhile, the narrative blames individuals. You should move, you should buy smaller, you should earn more, as if the problem is personal math instead of systemic design. Zoom out for a moment. When a society makes home ownership harder while making rent permanent, it doesn't just change finances, it changes behavior. People delay families, delay roots, delay long-term planning, and that has economic consequences that don't show up on housing charts. Lower birth rates, lower mobility, higher precarity. And none of this happens without a crisis headline. It happens quietly, one rejected application at a time. So when you hear someone say, just wait until 2026, things will normalize, ask a better question. Normalize to what? To wages that lag assets? To debt loads that never reset? To a housing market where shelter competes with global capital? Because that's the system we're in. And systems don't reverse on optimism. They change when pressure becomes unavoidable. The uncomfortable possibility is this: 2026 might not be the year housing becomes affordable again. It might be the year we finally admit that affordability isn't coming back the way we remember it. Not without redesign, not without trade-offs, and not without asking who the housing market is really built for now. The question isn't whether prices will fall. The real question is simpler and more unsettling. If homes are treated like assets first, what happens to everyone who just wants a place to live?